Hello everyone, we are live from Chicago. Today is Thursday, May 8th, 2025. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us tonight on a packed full show. In the slog, we'll talk about what a slog is in a little bit, but look at all the monitors, all the stuff going on. It's no fun to be in the slog for sure. If you're new to the program, please click the button on YouTube to subscribe to us and also click the little bell so you get notified when I go live or if we upload special content. And we will begin doing more of that later this month and definitely more in June and July. We're going to provide more content for you, shorter examples, so you don't have to wade through the whole show if you've seen it, but you just want to see one segment. You're going to see that there. If you have not subscribed to me on Twitter, which is now X, of course, Facebook and LinkedIn, please do that as well. I tweet every day. I've been tweeting 2 and 3 times a day lately because so much is happening so fast. And of course, our podcast channel, which started in July, you can see us on Apple, Spotify, Amazon, and wherever you get your podcasts. Usually every Monday, sometimes special content there as well. So click that bell and get notified. We're doing everything we can to provide as much content as possible. Our next show, this is one of those 3 times during the year when it's 5 weeks in between shows, not 4. Thursday, June 12th, we'll see you for that one. And again, be sure to tune into our other media. That's the tweets and the podcast to keep up with what's going on in the markets. That's important. These are the topics for tonight. We won't touch on every single one of them because the policy section is going to be by far the biggest section of the program, and I think you would understand why that is. So, 2025 performance. This will be the last time you see this slide. We have made the decision to remove performance from our regular show, and there are 2 reasons for that. The first reason is because we have gotten feedback that you want more content, and one of the things that I can do is cut performance and put it in a special program. So it's not like we're never going to disclose performance to you, those of you that are clients. But what we will do is we'll have a private podcast channel, and I may even do a separate live show just for clients 4 times a year, and it would be logical to do it at the end of March, June, September, and December. So if that's something that would interest you, please stay tuned for that. But going forward and starting tonight, this program will be purely informational and what I see in the markets so that we have a broader audience that are not necessarily clients, but it'll let you know how I'm making decisions. That part stays the same, all right? So here we go. The monthly market update in the slog. This is an informal phrase used to describe being in a period or phase characterized by slow, difficult, or tedious progress, or just plain stuck. The term is commonly applied in contexts where progress advancement feels laborious, or for a situation that feels, now remember, that's not thinks, but feels like no progress will ever be made. If you feel despondent because of what's happening in the markets, we have been here before, so it's okay to be in the slog. This is probably the 8th or 10th time since I've been doing this. We've been in a slog in the markets. It jets up, it jets back, doesn't seem to be going anywhere. We're off the lifetime highs, but fear not. We're going to, by the end of this program, my most important goal in this particular program is to make you feel comfortable with what's happening and give you hope that everything is going to be just fine. Exactly the opposite of what the corporate media is doing. I'm hoping you can watch this show and sleep well and not have to watch it again for a month, but you can if you want. It'll be out there, all right? This is what's in play, the U.S. trade balance and GDP. So the brown line is the trade balance. You can see it plummets once the tariffs hit. The net exports plummet. All right, it's actually become a negative part of GDP. This is not a permanent setting. This is just an intermediary time when all these countries are coming to the table. This is the most important takeaway on what is happening right now, other than we're in a slog. All right, but the most optimistic thing I can tell you is this is not a permanent condition. Donald Trump knows what he's doing. At least he thinks he knows what he's doing. And these tariffs will eventually go away. And the goal is to have no tariffs at all, so that free trade exists between all nations on this earth. That is what we would like to see, especially since we're the biggest consumer and we have the clout to make that happen. And that is what Mr. Trump is doing. You probably have seen in your portfolio for the first time, I think I went back 18 years, that I put gold in both CG and GI, but we're using this as an inflation hedge, and also it's just gone straight up. And even though it's not typically in a portfolio, we're using it temporarily. I'll talk a little bit more about this later on, but it's definitely a good time to be in gold. So this is a chart, never shown you this, all the way back to 1872. Look at the arithmetic return and the geometric return. So the arithmetic return is the sum of the averages of the returns on every single trade. And this isn't our program, so obviously I wasn't trading in 1872, but everything that's been able to be recorded in the U.S. markets. The geometric also takes dollar cost averaging into account on that, all right? So 8.6 and 7.1. Here's what I want to show you about this chart. How many years do you actually see that come in at 8.6 or 7.1? Like one or two. If I look carefully at 1908, I think I can see that. But we have outperforming and underperforming years. All right, that's just the nature of the markets, and you just have to get used to that. And most of you that have been with me now for 15, 16, some of you more than 20 years, understand that I'm okay with that. I don't like it, okay? I don't like it. I would like to be able to see some more normal years and less histrionics in the market, but that's just not the way it is, and it certainly is not going to be that way anytime soon. What's the longest period of negative real equity returns? Whenever you see that word real, the opposite is not unreal, okay? Real means inflation adjusted. So adjusting for inflation, let's say that you have a return on your account of 10%, but inflation's 3%, that means the real return of your portfolio is 7. So if you look at that, look at the number of years, Denmark, Canada, and the US, 15, 15, and 16 years, Australia 16, and everybody else far, far worse. Look at Austria, a century, all right, underperforming. It just happens this way from time to time. So that's why we believe the US markets are the best place to be. We will venture to Europe and to Asia. We've done that this year, and then when those stops were hit, we pulled back. But on a temporary basis, we certainly like investing across the globe, generally not permanent holdings for exactly the reason you see right here. This is still the best place to invest, all right? You guys that have watched this program since day one know this chart very, very well. If you're new to the show, let me explain it just a little bit. Secular bear markets are in red. Secular bull markets are the blue lines with a squiggly type underneath there. If you look at the yellow box, that's only there to draw your attention to the orange box. And now you need to really just move in on your monitor. If you have an iPad, you can pinch it and make the screen bigger. There's a little black line there that shows the current drawdown we're in. In the grand scheme of things, it's nothing. All right, the average return, annual return in this current bull market has been 12.1%. Not quite what it was from 80 to 2000, but I still think there are more legs on this secular bull market. And I think we could get that average up there. Certainly better than it was after the Great Depression. There have only been 3 secular bear markets, and we are not anywhere close to one right now. We are seeing, though, that U.S. growth is likely going to slow. And in fact, you could make the argument, if you're following the GDP that I tweet about, we had a negative print on GDP. That has an asterisk by it, okay? Because of the tariffs, there was a tremendous amount of buying going on and wiping out somewhat of the cash supplies in many, many, many companies, all right? Which means they will not be buying going forward until those supplies exhaust, and that does affect GDP, so much so that it printed just a small negative print. But technically, right now, we're sitting with our first quarter of negative GDP. That means if June 30's quarter is negative, that's technically the definition of a recession. I still don't think we're there yet, but we'll see what happens when we get there. All right, you guys know this chart as well. The average return for stocks, the 73% number that we use, is the average win rate for companies predicting whether they're going to beat earnings or fall below it. So the winners in this particular quarter were at 357 of the 500 S&P 500 stocks, 93%, 82, and 91. Those are the winners. We're at 74%, which is right there at 73. So we're really just looking at an average quarter. And if you look at everything that's going on, all right, all the way through March 31st, and the tariff talk was certainly in play there, even though it wasn't enacted, that is not a bad quarter considering everything geopolitically that we're dealing with right now. So I'm encouraged by that. U.S. policy. Why do we talk about policy? We all hate, I would guess, by now, politics, all right? But politics leads to policy, and policy leads to portfolio impact. And portfolio impact has personal impact. So it is really, really important that we pay attention to what is going on here. All right. This man, reviled by some, loved by others, the reality is he's the president and he's going to be that for a while. So I want you to look at this next page and just take it in. All right, now I'm going to read it just to make sure you guys took it in. Hey, Nellie, how are you? Hey, Andre. Hey, Martha. Glad you guys are here. Donald Trump is not everywhere, but it feels that way. At least that's the way the media makes it feel. More than any other president in modern times, Trump seemingly wants to inject himself into every facet of American life, from arts and culture to religion and sports. He's even put that picture out there himself as the Pope. Well, we did get an American Pope for the first time in 2,000 years, so that's pretty interesting. He wants to fill your weekend with jokes and memes and keep you talking about him. Is he obsessed with himself? Absolutely. All right. This reality will not change until 1201, January 20th, 2029, no matter who is elected after him. Just accept it. And that's what I'm trying to do, is give you the information in here to just deal with it, because it's what we have until that date. His tariffs are the highest since 1909. Look way back here, way back. 1800 something, they were higher, okay? That's like almost the beginning of the country, or 50, 60 years into the beginning of the country. And then in 1909, you can see that's where we are right now with that dashed line. So the highest since that time. All right, it's crazy. So the highest tariff rate in the world, nearly. There are some other countries that are not on this map that are a little bit higher, but our tariffs are the highest because he is using it as a strategic bargaining tool. He in no way wants to keep these tariffs this high. Nobody wants that, but he got their attention. Sometimes you have to do something dramatic to get people's attention, and that's what he decided to do. Today, and this shows you how current our show is, today these two men met and announced a new trade deal. This is the first major trade deal between G7 countries, the UK, United Kingdom, and the US, all right? Now, this is what's called a heads of terms or memorandum of understanding. I think it's kind of jive, actually. Do you guys have a deal or not? I mean, is this going to affect the tariff process starting tomorrow, or not tomorrow, but let's say June 1st? Well, there's still more discussion to go. At least that's what we're seeing. But it is a start. Now we just need another 10 to 15 countries to come to the table and do the same thing. It also establishes a framework, obviously, for further negotiations. The UK officials have indicated it's a substantive step forward, though many details remain to be finalized. I think really both countries just wanted to win, and they wanted to call a win. I would guess that there's actually nothing. Maybe there's a deal signed, but it doesn't have flesh and bones on it. as far as actual money being transferred. This I'm going to literally show you now, and I'm going to literally show you again later in the program because this is so important. What is the real investment return during tariff regimes? Again, look at the year on this, 1875 to 1913. So we are at 150 years on this, all right? 150 years. Look at the green line. Equities, 5.3. Yes, it's negative, but it's less negative than bonds and gold in the same Great Depression, 1913, 1930. 5.1, 1930, 1945, 4.8, 11.9 in the 80s and 90s. So I don't see anything here that tells me that tariffs are just going to wipe out any returns I have in the market. Will it make them more volatile? The market's more volatile? Absolutely, and I can attest to that as your portfolio manager. Well, for those of you that are watching that are not clients, all right, but many of you are clients, all right, it has been an exhaustive time. I'm training now 4 days a week, up from 3. I may go to 5. I have a client that encourages me to do this, and it's good because it's exhausting. It really is, but it's what we need to do to stay on top of it here. Look at the exports. Let's just look at corn. Almost all the corn we export is between the red and the blue. Look at the scale on the bottom, or the legend on the bottom. China and Mexico. Same thing with wheat. China and Mexico. China and Mexico. All right, those are our most important partners. We get all in a tizzy about Canada to the north, and are we going to upset them? I know this 51st state thing is really getting old. I get it. It's old to me too. Beef and beef products. So we have a lot of exports, but just understand that exports to us is not the same as exports to other countries. We do not need exports. It's a nice addition to our GDP, but we do not exist to export. China does. Mexico does. To some extent, Vietnam does. Smaller G10 countries like Switzerland do. We do not need exports. Please take that into consideration, all right, when you get concerned. So the leading sources of steel imports, this is what we're bringing into our country from Canada. So $7.1 billion. Take that in. $7.1 billion. We've paid that much in interest on our national debt in the last 28 hours, a little over a day. It's just a tiny number. All right, importing from Mexico, $3.5 billion. I mean, it's nice. It probably means a lot more to them than it does to us. You don't see these numbers in the corporate media because it doesn't cause you to get all consternated. Not constipated, consternated. Word of the day. Don't do that. There's a lot of drama that's happening right now. This is a leveraging tool that Donald Trump is using, and he's bluffing to some extent because I don't think China's going to back down. That's just my opinion. But eventually they're going to have to, or their factories will shut. And you'll see on a slide later on, it's going to be catastrophic for them if they don't negotiate. So Canada has said, we'll ship you oil. So you can see the chart here. The yellow line is the United States. The black line is Canada. This is pipelines, exports to Asian countries, primarily China, but also some to Japan. And Canada's stepping up to fulfill the void here. That's not going to last long, all right? Because Trump can use that as a weapon if he needs to and further increase tariffs on Canada because he wants to force the Asian countries to come to the table to deal. This is something you're going to see twice. Look at this chasm between China's exports with every other country. That block that you see at 1%, there's 65 countries there that are less than 1% of their exports. And then you have South Korea, Vietnam, and Japan about 4.5, and the U.S. all the way over at almost 15%. I mean, that is an enormous part of their GDP. If it were our GDP at roughly 40 trillion, that's $6 trillion in exports to a given country. We don't have anywhere near that much in exports to any country, which is why we're not at risk of losing this business, all right? But China definitely is. So these rising valuations, you guys have seen the volatility since I've spoken to you last, at least on this program. A lot of volatility in the markets. Markets go up one day if they think something's going to happen positive, and it's almost always tariff driven. Not entirely. Used to be Doge driven, but nobody's even mentioning that now. And that's the only time I'm going to mention it on this show, because it's just come out of the news because the tariffs are so prominent. So now, just in the last few days, today's Thursday, I think this was Monday, it might have been Tuesday, that Trump said he's going to have a 100% tariff on all the movies produced beyond American soil. So I'm not sure what you're going to do if you've got a shot with the Eiffel Tower. I guess you can Photoshop it in, or if there's a remake on The Sound of Music, I mean, maybe you could go to Utah and use those mountains, but it's not exactly like the Alps in Switzerland or Austria, right? But they're going to have to figure this out. But I do know that India is very concerned because 40% of their revenue comes from the U.S. Again, every other country out there needs us more than we need them. So why have we been dealing with these lopsided trade deals for 5 decades? It started with Eisenhower. Can't blame any of this on Truman. It started with Eisenhower, got worse under Kennedy, and then it just kept getting worse and worse and worse. Even under Reagan, for those of you conservatives, yes, he didn't do anything. Nothing. Neither did Bush, neither did Nixon. And Nixon went to China, as we know. So Volvo, cutting 5% of the jobs at a South Carolina plant, their South Carolina plant, but yet they still say they're committed to creating 4,000 jobs in South Carolina. This is just so much, there's so much going on. It's really hard to keep track of it. That's why it's taken me so many hours to keep on this, folks, but this will play out. This is a constant state of disarray, but there's a reason behind it, and I'm going to show you that just in a few slides, all right? Just hang with me. It's going to make sense in a little bit. All right. So here is the most important chart to be able to look at these deficits. We have the biggest deficit by far with China, and then Mexico, and then Vietnam. And actually Ireland at fourth kind of surprised me. All right. But the top 3, at the bottom, you're seeing billions of dollars, 300 billion. And that's last year. So we don't even know what the projection is for this year. It probably will be much less because these tariffs are in place and it's stopping the importers from wanting to pay these surcharges. We're going to talk an extensive segment on how tariffs work, because that's what I keep hearing from several people. You kind of explained it, but could you really just go through it step by step by step? We will do that tonight, all right, in just a few minutes. So China, there it is. And they're in this particular administration, they're tired of this. Many people are tired of this deficit, and therefore the tariffs kick into place, and billions, literally hundreds of billions of dollars so far, I think it's right at $200 billion, has gone into the Treasury from the importers that pay the tariffs. So yes, it is a tax that's being absorbed here. I'll get to the details on that. But it's slowing down the factory work in China big time. They are every bit concerned. So look at this again. I told you I'd tell you this. I said I would show you this twice. Almost 15% of all of their exports are to us. They are not in a position to leverage. There's nobody else on the planet. You're not going to go to South Korea, Vietnam, and Japan and say, we need you guys to buy more. We'll discount it. And those 3 Asian countries are going to go, we don't have the GDP to support this. We don't have the wealth in our populace to support this. All right. So that's where that is. Some farmers may need some exports. And that is true. Dr. J, thanks for typing that in. What else did you say here? Sometimes pro-Z. I'm not sure what you typed in that first comment above there. But yeah, when we get to the agricultural bit, that's going to need to be solved first, for sure, because we have farmers that do need those exports. I think that it's much easier to find other markets for our soybeans and corn and other grains, oats, than it is for these other countries to find the dolls and the Nintendos and whatever else, because there's just nobody else on the planet that has our spending power. So, but good point. Thank you for making it. So interestingly, though, China announced a first quarter growth beat. So can we really trust the data from China? I don't know. But if you look at this, Trump raised the tariffs. You can see this, right here at the end of the graph, and you will see that they beat expectations even amid the trade tension. Sorry, guys, a lot of data here for me to get through. I'm not sure that, again, I believe that, but we had a negative print on GDP because of tariffs. They're saying they have a positive print because of tariffs. Let's look at the revisions. As you might know, the GDP is issued in the first month, so it was issued this month, and then there'll be an update in June, another update in July, and then you'll get the next quarter after that, the original GDP print. So other than the news with England, this is the next biggest news, which is this weekend in Geneva. We're going to have Scott Bessent and Chief Trade Negotiator Jameson Greer meeting with China's economic czar. And they're going to have some talks. They're going to try to resolve the trade war. I think they will. I don't think this is going to have anything to do with an actual tariff deal. That's just my opinion. I think they're going to say, well, not us, but the Chinese, we have to de-escalate. We're not even going to talk to you about a deal until you de-escalate. And Donald Trump has instructed both of his representatives to say, well, then let's just get up from the table. We have nothing to talk about. We're not de-escalating anything. You need us more than we need you. And we've been unbalanced for 5 decades. We're financing your armies. I mean, that's really what's the reality here. Because of this imbalance, $300 billion plus, China can use that money any way they want, right? And I believe they're using it to arm their military. So we are arming the military of our biggest enemy. You may not believe that, but that is my opinion. And so there you go. I highly recommend, and this is what I've been talking about all night, you become familiar with the term strategic uncertainty. Strategic uncertainty will ensure the U.S. gets the best trading deals possible. No one values nor implements this strategy better than Donald J. Trump. He said it in his book decades ago, and he's doing the same thing now that he's done all through years. He is all about the art of the deal. He's playing with a lot bigger stakes now with the biggest economy in the world, and that's what makes it kind of scary. But again, I'm trying to lay out these facts as clearly as I can to give you some comfort, all right? So given the irreplaceable nature of the U.S. consumer market in China's export-driven economy, I want to say again, they have an export-driven economy. We have an import-driven economy. The good thing about import-driven means we can shut that off if we can, as consumers, say, you know what, we're going to buy locally. We may pay a little bit more, but we're going to buy locally, or we're just not going to consume as much. All right? And then there's no market. So as an exporter, you are beholden to your buyer. We are not beholden to sellers because we're that big an economy. All right? The bottom line, and these are Donald Trump's words, not mine, Washington has more cards than Beijing. So I mentioned earlier, I just want to talk about the mechanics of a tariff. And again, because this is a complicated topic. There's a lot of slides here, but let's just go slowly through it. And I hope that it helps. And I'm welcome to have anyone type in the chat box, Dr. J. I know, but we've talked about tariffs a little bit. We might not totally see it eye to eye, but I would love to know if this is something that is useful to you guys. When you get the survey on Monday, please let us know. This is going to be one of the longer segments I've done on just a technical story. So, all right. So what is a tariff and how does it work? When the U.S. imposes a tariff, the flow of money involves specific stakeholders and government processes. Here's the exact sequence. Payment and collection. So the importer, so let's just suppose we have an order coming off a boat for $10 million and it just landed at Los Angeles Harbor from China. And there's an importer that gets those goods. Now that importer pays the tariffs. That's somebody on our soil. American companies importing goods pay the tariff as a percentage of the product's value or a fixed rate per unit. It's going to be the former for the current tariffs that Trump has in place. This occurs when goods enter a U.S. port of entry, and I just mentioned Los Angeles because it's the biggest one in America. U.S. Customs and Border Protection collect the tariff, and agents classify the goods verified by their declared value and assess the tariff amount using the U.S. Harmonized Tariff Schedule. I'm not going to go into that, but you can now Google that phrase if it would interest you, okay? Importers self-report this information, but the CBP audits them periodically. That revenue that is collected by the CBP enters the U.S. Treasury, and those collected funds are deposited into the general fund of the USA, becoming part of the federal budget. I bet you didn't know that, all right? So that money comes from the U.S. So China hasn't paid a nickel at this moment, right? That 100 million or 10 million, whatever it was, and let's say that 2 million of that is tariffs, it's going to be more because of the amount of tariffs that are in place against China. That goes into the U.S. Treasury for the Treasury to spend any way that it wants. And let's talk about that. So what's the allocation and use? General government spending, so the tariff revenue is not earmarked for specific programs and can fund any federal expenditure, from infrastructure to defense. And for that matter, social programs and welfare programs and anything that the current administration, that doesn't mean necessarily the Trump administration, but if these tariffs somehow are still in place for the next president, they'll stay doing what they're doing until the current president at that time changes the flow of monies. So targeted relief, this is an actual example in 2018 that happened. Sometimes these tariffs subsidize industries like farmers. You mentioned this earlier, Dr. J, that maybe these farmers are going to need some help with the market. Well, they also could be subsidized like they were 7 years ago during the U.S.-China trade war of 2018. Maybe you didn't remember that. We weren't doing the show in 2018. We didn't start till 2020, but it's not new for the U.S. and China to be in a trade war because of the disparity, because of the import-export imbalance. It's just that this time, this president has said enough. All right? Budget deficit reduction or tax cuts. So while tariffs contribute plus or minus 2% of total federal revenue, which is not that much, all right? We're seeing all this enormous tariffs is going to just bankrupt people. It's 2%. It's 2%. It's just not a large portion, all right? They could offset a small portion of the proposed tax cuts or deficit spending. I would like to see them actually go in and reduce the debt, not the deficit, because that takes Congress, but the debt. Literally just Treasury could say, yep, we're just going to allocate $500 billion to go against the debt. And if you do that long enough, maybe over 15 years, we'll get the debt to zero. That would be good. All right, so economic impact. So the cost distribution, importers often pass tariff costs to consumers. Via higher prices, retailers and wholesalers may absorb some costs, reducing profit margins. However, there is another choice here, and that is that people say, I am not going to pay $2,300 for an iPhone. No, send it back. And then the importer goes, we should have checked with our end retailers. And of course, I'm being facetious. Of course, they check with their end retailers. They're on the phone with them saying, hey, we've got this order here. I'm having to pay this money up front. Are you going to pick it up? And if you're going to send it back to me, then I got to put it back on the boat. So it definitely complicates the life of the importers. All right, that's just the reality. So China, again, so far has paid nothing. What has happened, though, is that the importers at this point push back and say, you know what, we're not accepting this because we can't sell it. So just put it back on the boat and send it back. Now you have China's attention. And the factory orders are plummeting over there, and the people are not working. If you don't believe me, we can talk about that. It's kind of beyond the scope of financial commentary, which is what I'm doing here. But everything I've talked about so far affects the markets. And again, I'm kind of on a vigilante role here to show you how these work so that it reduces your angst about this tariff war. This is temporary. It's been done before as recently as 2018. That was not as bad as this one because this one involves literally every country on the planet. And as some have pointed out, even some islands that only have penguins, they've been tariffed too. So almost kind of funny. So global effects, all right? Tariffs can alter trade patterns, incentivize domestic production, and that is the key. Incentivize domestic production. We want more goods and services like pharmaceuticals, like rare earths, like lithium development. Now, we don't have much lithium right here, but there are other islands in the Atlantic that do, but I digress. All right? But local domestic production within the borders of the United States, that is what Mr. Trump wants to see. And consumers can reject buying products that are no longer perceived to carry a fair value, i.e. too expensive, and that is already happening. So the idea that a consumer is going to be pinched by something they have to buy, these are mostly consumable goods. These tariffs are not coming in on food products unless it's, French wines or chocolate from Switzerland, all right? Not exactly staples that we have to have. So that's why there's not that much risk here as far as discomfort to the consumer. This process underscores that tariffs function as a tax. That is true on U.S. importers and consumers if they choose to spend. The importers have to pay it or they can't get it off the boat. But at some point, the U.S. importers say, you know what, we're done with this. We don't have a market, send it back. And this revenue is managed through the federal budgetary channels. I'm going to pause here because I've talked so much. And you guys ask me anything in the chat that you want, all right? I'll go on to the next screen so you can look at it because we're going to talk about the difference between embargoes and tariffs. I know this might seem a little far-reaching, but you guys have asked for more detail and I'm giving it to you. Again, the purpose of this episode tonight is with everything you're hearing in the media to make you feel more at ease and comfortable that this is a short window in time we're going through. We have been here before, most recently 2018, and it will pass. Thanks for listening, SK. I don't know you, but I'm glad you're here. Thanks for commenting, and I hear you. I feel your pain, buddy. I do. Thanks for being here. So why are high tariffs called the equivalent of an embargo? Well, one is a legal situation and the other is a financial situation. So in the current context of the trade conflict with the U.S. and China, tariffs have reached an unprecedented 145% entering the U.S. and 125% on U.S. goods entering China. It's crazy, unsustainable. So at these rates, the cost of importing goods becomes so high that trade is effectively stopped. Why? Because the importers are saying, just like I told you, hey, we're not going to pay this because we don't have consumers that'll buy it from us. And we're not going to be left holding this inventory all marked up. If the tariffs go away, then we've paid X amount for this inventory and already sent our check to the Treasury and we can't get it back. All right. So the importers are the key player in this. Not the country that's being tariffed against. It's the U.S. Importer. So that's why top officials, primarily Treasury Secretary, all right, Scott Bessent, have repeatedly said 145, 125, these levels are the equivalent of an embargo because even though it's not legally saying you can't buy this, they're high enough that they're the equivalent or the proxy of an embargo. We don't want to decouple. What we want is fair trade. That is what I've been saying throughout. Obviously, Donald Trump has hired people to work for him on his cabinet, in his major departments, his secretaries that agree with his point of view. And there are quite a few of us out there that are tired of this imbalance, tired of America being taken advantage of, and want to see this change and realize that there's going to be some discomfort. It's not going to be permanent. You got to believe me on that. It is not going to be permanent, all right? When tariffs are set so high that they make imports unaffordable or uncompetitive, the practical effect is to call them an embargo. Trades in those goods essentially ceases. But are they the same? No, they're not, because tariffs do not legally prohibit trade, but they can make it economically unviable. An embargo, on the other hand, says you cannot ship X to X. This happened with chips, all right? NVIDIA, where NVIDIA was told, we're going to embargo your chips to a given country, probably North Korea. You can't ship them there, all right? If you do, you're going to face a felony. All right, that is an embargo. And NVIDIA could say, well, we'll just make them, 6 times the cost of what they're paying for them in South Korea. And the U.S. government can say, no, you can't. You can't do that. You're on our soil. Now, they don't have that kind of control over Roche Pharmaceuticals in Switzerland. You can't tell Roche Pharmaceuticals, who's domesticated in Switzerland, what to do. But you can tell NVIDIA. Make sense? All right. So in practice, when tariffs are set at levels like this 125, 145, the result is very little, if any, trade occurring and mirroring essentially an embargo's impact. However, unlike embargoes, tariffs theoretically still allow trade if buyers are willing to pay up. All right, but it's an extremely high price. This is a chart that summarizes it. So in conclusion on this segment, while tariffs and embargoes are not technically identical, extremely high tariffs can make trade so impractical that they are the equivalent of an embargo in their real-world effect. This is not just a theoretical or rhetorical comparison. The current U.S. and China tariffs have reduced trade to a trickle, mirroring the consequences, and that's why I brought this to your attention. This is what Donald Trump wanted, okay? This is confusion strategy, which I just mentioned to you earlier. It actually uses a different word for it, but that's essentially the equivalent of it. It's to get them in a panic because they don't know when his end date is. And Scott Bessent has said that. See, when you interview me, Mr. CNN, he'll say to them, we know everything. We know what we're going to do, how far we're willing to go, how long we're willing to carry this on. You don't know any of that, nor will you, because why would we tip our hand to you, the media? Even if you were friendly media, because it's just going to go out in the airways and tell our, trading partners. We don't want to do that. We're holding the cards. We have all the cards. This is Scott Bessent. And we're going to use them to the advantage of the United States citizens to get this country where free trade is truly free trade. Questions? Anybody? I want to show you this chart again. You got to be thinking after we've waded all the way through this, what does this mean for my returns? Well, look back 150 years. Look at the green line. I already showed you this once. Every single time we've had a severe tariff regime, equities have been positive except for during the Great Depression, and then it was only down 3.1%. Now, obviously, stocks were down more than that, but as far as the effect of being down as related to tariffs, actually up almost 12% in the 1980s and 1990s because the rest of the market was strong. So overall effect on the market from tariffs, the point I'm making here is relatively small. It just gets the news, all right? And it affects me. I mean, we get stopped out of some stocks and I replace that with other stocks that are stronger. I mean, we're more actively trading if you're watching your statements, if you're clients on this broadcast. If you're just listening to what I'm doing, just trust me. I've been on the phone with a trader in New York, one in Arizona. These are people that I talk to. So how's it going out there? I'm going to actually show you the result of something that the very last slide that one of my trader friends sent to his clients. You'll see that coming up. Pretty interesting. Okay, so there's actually more going on besides tariffs. This is a chart of executive orders. You see the spike there on day one? All right, Donald Trump is at 143 when this was done. I think probably by now it's 150. Truman, Biden, nobody else is even close. They don't have the presidents labeled there, all right? All right, I want to get Dr. J's question here. Will domestic producers raise prices but keep them less than imports since they have now given some room on pricing? I don't know. I think it's still too young. Remember, this has only been going on for a month. April 2nd was called Independence Day or whatever Trump named it. And we're at May 8th, so it's really 5 weeks. We have to wait and see what they're going to do as far as domestic producers. We're not sure that consumers are going to make the switch to domestic producers yet. We'll know by the end of the summer. And of course, every market, let me get back on camera, we'll now know that will they switch for food? Will they switch for, Mattel is really concerned because they sell tons and tons and tons of dolls here. And now as we get closer to the Christmas season, people start buying Christmas in September and, May is going to be over here in about 15 days. I don't know, 20 days. Let me add up right here. Just trying to keep a lot of things straight. We're going to be in the summer quickly. How about that? All right. It'll be interesting to see if domestic producers start to see more demand and therefore raise prices, which you're right, could exacerbate inflation from internally, not from trade. So Trump's budget proposal. So in addition to everything going on with tariffs, this is where he's seeing he wants slash. So 163 billion slash from domestic spending at the federal level, no cuts in Social Security or Medicare, but caps on the amount that federal government sends to states from Medicaid and a work requirement. And I think that's absolutely reasonable. Obviously, you're not going to ask the mom who's got 4 little kids at home to work, but there are plenty of able-bodied men and women that could be working, seeking a Medicaid benefit. Proposed budget cuts, Commerce Department, education. I'm surprised education is only 15%. I thought he was trying to literally disassemble that agency. Energy, and then the EPA, 55%. I guess he sees a lot of waste there. All right, Health and Human Services, Urban Development, Labor Department, and NASA. I think ultimately you're going to see that our space program is privatized. It's going to be competitive between Jeff Bezos's outfit and Elon Musk's outfit, and maybe other billionaires will enter the fray as well. Pardon me. So what about the increases? All right, Department of Homeland Security. Well, yeah, 114,000 aliens, illegal aliens, have been expelled from the U.S. since January 20th. Defense Department, only 13%. I'm surprised that's as low as it is, and I think that that's because Hegseth has said, look, we can make cuts here too. There's all kinds of money that's being spent here. This is Hegseth going to Trump, all right? So Transportation Department a little bit, and Veterans Affairs, actually a budget increase. So again, what are you seeing in the media? That we're cutting employees at the Veterans Administration. Well, maybe there are some, but the overall budget is going to increase for veterans, and I'm all for that. These veterans protect us and have protected us so that we can go on about our lives and do what we're doing. Let me get Martha here. AG Secretary said yesterday prices way down on eggs and other items. Yeah, they've been quoting that. Trump likes that eggs. He even called himself an expert at getting prices lower. I can't make that up, folks. All right. I think you're seeing a lot of fixed goods prices, even clothing, coming down. And so inflation is reducing. It just is. It's obfuscated, another word of the day, obfuscated by all these tariffs, which have the implication of really raising prices. I think consumers are going to have to face consumption decisions. That's what we're going to see. Right now, I still think they're just kind of deer in the headlights for the first 5 weeks. But by Labor Day, not Memorial Day, Labor Day, you're going to see consumer patterns change. It'll be interesting to see. It'll be the first time it will have gone on this long. If it does, China might not even have a deal until the end of the summer. It could absolutely be that long. It could go into the autumn, because they're really hard-nosed, and Xi Jinping does not want to bow to Donald Trump, even though that's ultimately what's going to have to happen. So I highly recommend you, this is the second time, all right, that I've said this, be familiar with this term, strategic uncertainty. Donald Trump thrives on making uncertainty and angst for his opponents, his political opponents and his trade partners. And it does not matter if you are China, North Korea, Russia, Iran, or Germany, France, Switzerland, and Canada. There are no friends in his mind. This is what has been so abhorrent to so many of the people in the blue states. They think we should be treating these other countries that are our allies differently. But if you look at the trade deficits on the page I just showed you a few minutes ago, they have been treating us very poorly. Now, they got away with it. So they're saying, yeah, well, we got away with it. So now I guess we can't. And that is true. You will not be able to do that anymore. All right, here's Jay Powell. Poor Jay Powell. Trump hates him. He wants him out of there. He's not going to fire him. Okay. It's just he's going to have to deal with it. The Fed held rates steady. We did not expect to see it drop. It will be June, probably July, before rates drop. GDP fell, but I already explained that earlier. Do not be too concerned about that, because that drop in GDP, if you remove the effect of the tariffs that have happened in the last 5 weeks, all right, we are actually positive in GDP for the first quarter. Now, I understand his Liberation Day was April 2nd and first quarter ended March 31st, but all of this was going into place. Everyone knew what was going to happen. So one thing about Trump, he doesn't just come out, well, sometimes he does come out of nowhere, but not with this tariff thing. He's been talking about that since before he was elected and certainly ever since then. So the Fed signals it's going to be unchanged, not make any changes for some time. I think that that's not going to be the case. You can see the possibility the U.S. 2-year government bond yield continues to drop. It's not dropping as far as I'd like to see it, frankly, and I'd like to see the 10-year so that real estate rates become more effective too. We didn't really cover too much in real estate going forward here tonight, but just know that that's what they're signaling. Central bank, on the other hand, with China, cut their 7-day repo rate. All right, you can see the little bars going down there. So China is already adjusting to what they think they're going to need to do to protect their yuan. The Chinese yuan is their currency, to buttress themselves against this tariff war. All right, and the Fed doesn't see the reason to do it. So the market continues to price in 3 cuts this year. Probably June or July, September, and November. That's what I'm seeing. And that will be really helpful for the markets for sure. So it's kind of caught in the fog. It's hard for them to make an accurate forecast simply because the tariffs could go on for weeks or months. They will not go on for years. They could go on for weeks or months though. So inflation, I just have one chart and I'm hoping this will bring you some peace. This is from the International Monetary Fund, IMF. Fund, I should say, not phone. Inflation peaked, folks, in 2022. I mean, there it is. This is worldwide inflation, and we're forecasting into 23, 24. But look at what actually happened. All right, in 24, it just continued to drop. Now, is it as low as we want it to be? It is not, but the trajectory is where it needs to be. And I've been saying this in this inflation section for months now, all right? Could tariffs inflate our consumable items? They could if it stays in place for a long time. I think it's going to do the third of the choices that I explained in that tariff section. It's going to change consumer behavior, and I think that's a good thing. So employment scenario, as you know, we do this show the second Thursday of the month because the first Friday of the month is the non-farms payroll, and there was a little bit of a disappointment, not much. The survey was for 138,000. The actual was 177, but it's in the sectors where it was located, all right? So healthcare, social assistance, that's good. It's not like it's in the consumable area of the market. So yes, we saw a slight increase from 138 to 170. So the survey was 138. The actual was 177,000 new jobs. Federal government took it on the chin there. Obviously, we know that because of Doge. That's only the second time I've mentioned it here. But Americans' outlook for finding a quality job, this is the first time I've seen this chart invert in several years. The brown line is the percentage of people saying it's a bad time to find a new job. And the green line says it's a good time. Well, you can see that's flipped here this year. And it's not that it's tough to find a job. It's just not as good. But guys, when I was doing this show 2.5, 3 years ago, there were 3 jobs for every one person looking for a job. That's not the case now. And work from home is not an absolute given. You have to work a little harder to find a work from home job if that's really what you want. But what people are saying is it's just tougher to find. Not anywhere close to look at 2010. I mean, where you could see the bad time was way up there in the 85 percentile. We're not even close to that. So recession, the odds are higher. And this is because, again, that I think it's erroneous data. The 0.3 negative GDP report for the first quarter, I believe will be revised. It may not be revised positive, but if it goes down to like a 0.1, the Trump administration will say, we're sorry, we're not going to call that a negative quarter because of the tariff effect. So poly market, which is the betting market, is basically saying, hey, we see a 63% chance. Actually, they're not saying it, the bettors that say it. And this is the company in England, because you can bet on things like a recession, but you can't bet on presidential elections in this country, at least not now. So that's, I reported on this a lot during the election season, September, October, November of last year. Recession probability, this is another survey, the Call Sheet 2025 recession probability. So it was way up there. It backed off a little and now it's gone back up. There's still jobs. We're not seeing any reduction in unemployment. In fact, as I said, you just saw 2 slides ago that it's going higher. It's not on fire, but it doesn't need to be on fire as we're heading into the summer. It just needs to stay positive. And that's what we want. All right, Ag Secretary said yes, the price. Yeah, I saw Martha. I think I've seen all the comments here. If I miss one, let me know. So characteristics of a U.S. recession. It's important that you understand this because, again, the media will tell you something else. So the depth of recession is important. A significant contraction in economic activity, such as a 1.5% decline in real gross domestic national income or a sharp drop in employment. That's one of the metrics. The standard cliche metric is 2 consecutive quarters of negative GDP. So if it comes out on June 30 that June 30 was negative, there'll be plenty of pundits in the media that'll say, oh, we've entered a recession. Well, by the time we know we're in a recession, unless it's a really, really deep one, like 2008, 2009, we could be coming out of it. Exactly what happened in 2020 with COVID. Everybody declared the recession of COVID and that it was going to be there forever. And then the market was up like 30,000, not 30,000, but I don't know, 15, 18,000 Dow points within 5 weeks. So don't let that confuse you. Duration, if it stays on for a long time, at least in 2 quarters, which I just said, widespread impact. So it's got to impact more than just 1 or 2 sectors. There were quite a few sectors that were not affected at all during COVID, for instance, and even some that were not totally affected in 2008, 2009, but definitely the financial sector and technology especially was affected in the recession of 2000, 2001. All right. So GDP decline, the 2 consecutive quarters, employment drops, we have not seen that yet. Reduced consumer spending, we have not seen that yet, although you'll see in the next segment here, there is some warnings about that. Industrial production dropping off. We're not there yet, folks. We're not there yet because our own domestic production and consumption is so strong. I'm telling you this to give you confidence that the leaders in this country, I'm not talking about the political leaders, I'm talking about the executives running the businesses that are making widgets for people to consume, to eat, to lie on, to drive, all of those widgets, right? They know what they're doing. They've been doing this a long time. That's why we are the most successful country in the history of this earth. And we've done it in 249 years on July 4th. All right? So this section is always where I talk about economic indicators that are not necessarily affecting what's happening in the market today, but I look out 6 to 9 months, which is really to the end of the year. How can it affect what we're doing and how we're performing at that time? So the Trump administration is garnishing wages of 5.3 million defaulted student loans. Realize that there are some people that have 2 loans or 3 loans. So it might not be 5.3 million people, but it's going to be 2.5, 3.5, maybe 4 million people. That's a lot. Garnishing wages. Why? Because 43 million Americans have student debt and they've stopped paying on it. Why do they do that? Because the previous administration said, don't worry about it. Now you don't need to pay. We'll just forgive that. Well, not anymore. Garnishing wages, okay? Is that going to affect consumer spending? It could. I don't know what the effect's going to be. It hasn't happened yet. He's just saying he's going to do it. And I'll be watching that over the next few months. People planning to buy a home is at a low since 2022, which was a negative year in the stock market. So that was a year of low confidence. It's right there again. If it goes down much lower, it's going to be the lowest in almost a decade as far as people planning to buy a home. Does that mean it affects us now? But it definitely could by the end of the year. What about manufacturing hire employees? We just took out the low. We're back to 2017 and earlier than that. Almost a 10-year low on employers expecting to hire new people. Could that change? Yes, that's why this is a very forward-looking set of economic indicators. All right. Bearish sentiment on the dollar. If the dollar continues to drop against other currencies, then money will exit here and go to European and Asian countries to get a higher rate of return. It's called the float on their currencies. All right. I don't really see that right now because the dollar is still trading over 101 on the Bloomberg index, which doesn't matter to you guys, but it definitely hit a low point on April 25th. It's followed back up from that, but it is something I'm watching. All right. The sentiment for the dollar affects investment in this country. All right. University of Michigan consumer expectations, again, near a 2022 low. And if that takes that out, it's going to go back to 2011. So that's a 14 or 15 year low. University of Michigan has this sentiment survey, and they're really famous for it. That's how they train their students in statistics. So it's a great survey. But we don't want to keep this trajectory going in this direction. All right. Home values continue to climb. All right. Continue to climb. There's more value in home equity than in financial assets. And what that tells me is people are not moving. They're staying in their home because they don't want to have to refinance at a higher interest rate, but they're also not saving more. So the equity in their home is growing and their financial assets are not growing. Ideally, you want to see those grow together because we want to have diversification between liquid assets and real assets, hence the reason it's called real estate. All right. So construction spending, most recent month we have is February. It's kind of flatlining. I don't see it as a real big concern, but we're watching it. So, all right, I'm going to finish with just a little bit here on our investment methodology. So, you know that we do a podcast, and that's where I talk to you about things that I don't have time to do here or things that happen that are salient between my monthly shows. So I subscribe to this one guy, and he has had some real frustrations in the market, and he expressed them. So he shows this chart of 2008. Obviously, this is 2025, but he's going, if you just look at this chart, guys, just understand we're going through a little bit of a drawdown, and we are too in our accounts. I know you guys know that are clients, all right? But you can see the ride to 92.9 return, and you look at the bottom of the chart there, year to date, 92.9. This was 2008. Now, you might say, well, wait a minute, the stocks didn't do anywhere nearly that well. So this is what's called a macro trader. So he can go long and short the market. He's trading commodities, etc. So forget that part. It's the sentiment that he expresses here and the frustrations with trying to stay with a trading plan. All right. And this will ring in for some of you that have called me because the next to last paragraph, you'll get it. So at the end of quarter two, you could be saying, oh, life is good. Quarter two, that's June, right? 65%. I love trend following. All right. The system at the halfway mark of the year, 65.9. You can look across the year to date in June and you're thinking, man, this is great. What I would be thinking is I'm ready to pull everybody out of the market and say, you're going to have to pay me for the next 6 months, but I'm not trading because if I can get you a 66% return on an annualized basis, I'm taking 6 months off. And you need to be prepared, folks, that I may do that someday if we really outperform like that. Because what happened after that was it got really bad. Enter quarter three. Year-to-date performance sat at a stellar 70.2, all right, on July 2nd. But over the next 59 days, and that's less than 2 months, the system gave up all. Now, the system is his trading strategy. It's what I've told you about many, many times. I'm not doing it tonight because you go back and see it. And again, we're going to pull those segments out from previous episodes where you can just go in and say, I just want to see how he trades this breakout, or what's his stop loss system, or how does he select stocks. You're going to see all of that in the YouTube channel, which is why you need to subscribe, which is why you need to click that bell so you see these episodes when Josh and Tommy put them out there, okay? So all of the year's gains, all of them on September 22nd, gone. I repeat, all the gains. Now, this is my friend, Michael Melaninos. I don't ever get his last name right. Melasinos, all right? And he's sending this to his clients and saying, so are you really prepared for this? How are you feeling now? Life still good? Still loving trend following? Are you encouraging your manager to stick with his system, or are you asking him what's wrong with it? Well, I have that happen from time to time where people say, are you sure what you're doing is right? Well, I don't know. Yeah, I am. I am sure. I think we have a very strong system, and it has performed well in a variety of markets. It doesn't always pick up every bottom, and it doesn't always sell at every top. but it's a very plausible working system. And then he goes on to say, so you see this number? Did you throw up all over yourself yet? If you did, it's okay. I'm sorry, that should have been a warning. This is a PG commentary. But this guy was expressing that we don't always get the expectation of performance that we want. We do our best as money managers to mitigate risk. Our job, his, mine, Tom Basso, who I've interviewed 4 times on this channel, and many, many others, billionaires, multi-billionaires, their job, our job, is to deliver the highest risk-adjusted returns possible, given the market conditions, while protecting your equity to the greatest degree possible. If all you made was 3.5% to 4% every year, you just put it in a CD. Well, actually, for years, you couldn't even get that in a CD, right? Like for decades, you couldn't. All right. But if we were up like this 2008 showed, I mean, this is at least, fortunately just 1 year. And then 2009, after March 9th, 2009, which is the low, 676.53, I think, in the S&P 500. And then it got on track. But there will be years like that. Folks, this isn't one of them. 2022 was pretty ugly. 2020 was ugly, but if you look back on that, you're going to remember that CG did 62% in 2020. All right, the S&P was like up 32. All right, so we have those kinds of years from time to time. And that's just what he's saying, that just hang in there. We do know what we're doing. Those of us in the business, it can be frustrating when you don't get the returns that you want. So that was our show. Have I missed anything here? Trump and company have set us up for tremendous wealth for every citizen. And I appreciate you offering that, Martha. I know there are people that won't agree with that, but I do believe that this man wants the best for America. He is born and bred, raised New York. He became a billionaire because of what he's done. He's seen other people go on to become even greater billionaires. And I don't think that what he's doing, he's implementing for the billionaires. All you have to do is look at the vote in 2024 and see the number of blue-collar voters. See the unions that are supporting what's going on with the tariffs. Now, I understand that General Motors is kind of concerned about this tariff situation, but in general, the workers are going, you know what? We can't compete with these foreign workers. Let's level the playing field. Have you ever been to Tokyo? And we have somebody on the line that has been to Tokyo many times. Have you ever seen a Chevy? Okay, a Ford Bronco, a Ford F-150, a GM car, a Cadillac? No, because they don't accept it. And yet Japan is arguably one of our top 3 or 4 allies. Why don't they do it? Because it hurts their local production. Okay, well, it hurts ours for this trade imbalance. And that is what this president is trying to do. So the resources in America are just beginning to be released with regulations removed. And I think there's truth to that too. Certainly, we are energy independent in this country, and Trump is going to leverage that to the absolute nth degree, in my opinion. All right. So there we go, guys. Next show, June 12th. I mentioned that. Don't forget my podcast. Do subscribe to me. We are on Podbean, Apple, Amazon, Spotify, even YouTube. You can go to our regular YouTube channel where you are right now and click on the podcast button, and everything gets published there too. So we're trying to make it as easy as possible for you guys to see what we're doing, because I want to bring you peace of mind. Yes, I technically manage money, but what I really offer and get paid to do is to bring you peace of mind so you don't get scared by what you're hearing in the news. I'm giving it to you straight. This is really what's happening in the market. These are the signals. I am trading on these signals. All right. In summary, every episode we finish with this: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. I hope I have left you with no fear, or much less fear. Let's just start there, all right? And confidence that this country is going to survive whatever happens, any political turmoil, because the backbone of this capitalist country is super strong. and we're all going to be fine. You guys hang in there. Enjoy this beautiful spring. At least it is here in Chicago. We'll be back in June. We'll know by then how the S&P has performed in the first quarter, and then by July 1st, we start reporting second quarter earnings, and the cycle goes on just like it has every year. You guys hang in there. Subscribe, okay? Subscribe to my podcast and my tweets. I'm keeping up with you every day because I want you to know and I want you to feel like you can believe in what's happening in America. God bless you guys. I'll see you next time.